In today's video, I'm going to look at some of the longer term cycles where I think things might be heading in the next 4 or 5 years. So to begin with, I want to look at the dollar. This is what I have in the upper section of this chart. And the first thing I want to point out is the dollar has, I've discussed the 3-year cycle many times in the past, generally runs about 3 to 3.5 years in duration, but the dollar also has a longer 15-year secular cycle. Um, and you can see it pretty good in this chart here. We've got a top here that came kind of as a bubble, and then a move down into that 15-year cycle low that ran basically 2 of those 3-year cycles. And then we've got another secular bull phase, followed by the declining phase of that 15-year cycle. And I think we have probably started the declining phase of this 15-year cycle. So you can see here when the dollar moves back below this 200-week moving average, um, it's not been usually a very good sign. Now, of course, this has to come late in that 15-year cycle. It doesn't, the 200-week moving average doesn't do much when we're in the bottoming phase here. You can see the dollar can bounce back and forth above and below that support and resistance zone multiple times as it's nearing the bottom of a 15-year cycle low, a secular bear market move bottom. But once the bull market starts in earnest, then price has tended to hold above that moving average as it's rising. You can see here and again here during this bull market. And then once that 15-year cycle tops, we get a move below the 200-week moving average, and then you historically anyway, you get at least 2 of those 3-year cycles before you reach the secular bear market bottom. So bubble top here, triple top here. Here I think we're forming a megaphone top, and let me draw that in. All right, so I think this is what's going on here. The dollar has rallied about 9 years, and that's about par for the course. The advancing phase of the 15-year cycle runs about 8 to 9 years, and then you've got about 6 to 7 years down into the secular bear market bottom. So if I'm correct here, and this penetration of the 200-week moving average is probably a bad sign, just like it was here, just like it was here. We attempted to break out back above that recently in the last couple of weeks, but that breakout has failed, and the dollar is back below the 200-week moving average. Again, not a good sign. I think it's an indication that this 15-year cycle is topping, and as I had noted in one of my past videos, I was incorrect in my original call that the 3-year cycle low was occurring right here. That's not correct. This is the 3-year cycle low right here. It's just a little bit stretched. But this is why we've had such a powerful bounce out of this bottom, because this is a multi-year cycle low. But it is not showing any indication that it's going to come back up here and regain these highs. It should have done it during this intermediate cycle if it was going to do it. And this intermediate cycle has probably run its course. It's pretty mature, 27 weeks. And it's not holding above this 200-week moving average. So it looks to me like this 15-year cycle has topped, and we're going to get a move back down And if we break down out of this megaphone pattern, usually it will, these kind of topping patterns will unleash some pretty severe selling once the lower trend line breaks for good, and you'll get this truncated rally that can't make it back up to the top of the um, pattern, and then that's usually the sign that the pattern is preparing to break down. So I think there has to be consequences to all of those years of QE. And I don't think the consequences are just going to be that we've got a bull market in stocks. I think we've got to have inflation, and I think we're preparing for that right now. So now looking at gold in the bottom chart here, um, you can see these periods where the 15-year cycle is in decline have usually powered um, bull market moves in gold. And even here, even after the bubble had burst back in 1980, when we had this initial move down from the bubble top, the popping of that bubble in the dollar, it still drove a very nice 65% plus rally, a bull market in gold, um, even though we were coming off of the bursting of a bubble. So, in theory, gold should not have entered really a bull market after a bubble had popped. It would need many years still to consolidate before starting the next one. But even so, this declining phase of the 15-year cycle in the dollar still managed to power a 65% plus bull market in gold. And then, of course, this declining phase of the 15-year cycle powered a major bull market in gold. So now the question is, has gold topped like it did here, and we're going to go sideways for another 20 years? Or is this move down just a fake out move before gold starts to take off and come back up, test these all-time highs, break out above the all-time highs, and finish this bull market that started back in 2001? And it's a tough call. I tend to think I'm leaning towards this being a long consolidation phase similar to this, but I also know that this is how big trending moves start. They start with a total despair, everybody convinced that the market is going down forever, and that sets up the kind of negative sentiment that can drive a really big, strong trending move. So clearly, the reason for this very powerful and sustained drop in gold is that the dollar is bouncing out of a 3-year cycle low. But if I'm correct, and this 15-year cycle in the dollar is ready to roll over, then we could get a much more powerful move out of this bottom than what anybody is expecting right now. So next I want to look at the relationship between gold and the CRB. Of course, they're both commodities. CRB is the commodity index. Gold tends to bottom just a little bit before the CRB. So we've got a good example here at the bottom of the recession. Gold started to anticipate just a little ahead of the stock market in the CRB, bottomed back here in November, I believe it was. Stocks in the CRB just a little bit later here in February. Again here in 2016, Gold bottoms in December, and the CRB in the stock market um, in February again. So a little bit, uh, you know, gold was anticipating just a little bit ahead of the rest of the commodity complex, and I tend to think we probably got our intermediate cycle low last week in gold. The CRB is due for a 3-year cycle low. Um, like I said, typically they occur about 3 years to 3 years and 6 months. This last one took 3 years, a little over 3 years and 6 months. So it's entirely possible that this one shortens just a little bit, and maybe we get the CRB gets its final 3-year cycle low maybe in October or November, and gold anticipates just a little bit and it has bottomed in August. One thing I'm watching is the stock market here. Not always, but quite often, the CRB will bottom along with the stock market when the stock market creates an intermediate cycle low. And it's been a long time since stocks have given us an intermediate degree correction. They're definitely due. I think we're in a stretched daily cycle right now, but we're right up against resistance here at the January top. If we get through that, maybe marginally, we're going to have resistance at that big round number of 2,900 on the S&P, 8,000 on the Nasdaq. That could be a potential spot for at least a pullback into a daily cycle low. And as I've noted before, these intermediate cycles that are extremely right translated rally for a long time, they can move down into an intermediate cycle bottom very quickly as kind of a crash event. And you can see that's what happened here in February. An extremely long intermediate cycle, very right translated, and then everybody tries to hit the door at the same time, and you get a sort of a mini crash type event. And we may be setting up for something similar in the stock market here. So while I do think obviously we have broken out to new highs, proving all the perma bears wrong again, but I don't know that we're going to get a sustained breakout here. I think we've got some big resistance at 2,900 and 8,000 in the stock indexes, and we could get another one of these mini crash type events that give us our next intermediate cycle low here, and maybe in early September, or maybe we got to get past the elections. Hard to say, but that is one thing that's overhanging the market, and it's possible that the CRB could complete its 3-year cycle low at the same time that stocks give us an intermediate degree correction. And then finally, if the dollar is starting the declining phase of its 15-year cycle, then I could see that as the driver for not only gold and commodities to go up, but stocks as well. And you can see from this long-term chart we're already getting pretty stretched, especially in the Nasdaq above these long-term moving averages. The S&P and the Dow, not quite as extreme as the Nasdaq, but in a similar situation. The next 4-year cycle low in the stock market, something similar to this, and this, is going to be due in sometime in early 2020. So, I've been saying for several years now that 10,000 is going to be a piece of cake. If the dollar starts the declining phase, or is in the declining phase of this 15-year cycle, then I could see, as the dollar moves down, it could push everything, commodities, oil, gold, and the stock market higher, and we could get we're already stretched pretty far above these moving averages as it is, but by maybe the middle of 2019, we could be hitting 10,000 on the NASDAQ. And at that point, I think we would be set up for quite a strong move back down into that 4-year cycle low that would at least come down back down to test this 200-week moving average, similar to what happened at this 4-year cycle low and at this 4-year cycle low. So um, I think we're setting the stage for that next major sell-off in stocks if the dollar continues down and we put in that next 3-year cycle low in 2021. I think it's going to drive the stock market way too far above these moving averages, and that's going to set up a regression event and a very strong, sharp sell-off into the next 4-year cycle low. And as I've pointed out several times in the past, oil is the precursor to a recession. If energy spikes, if oil spikes 100% or more in a year or less, that's usually too big of a shock to the economy, and it's triggered a recession every time since the 1940s. So I'm going to say we were at about $60 here in early 2018. If by the middle of 2019 oil is up here at $120, then not only are we going to have a big regression event in the stock market to move back down to this 200-week moving average, but we'll probably have a recession to exacerbate things at the same time.